Warren Buffett says, "Things that can't go on forever will end." Warren Buffett is known as one of the best stock market investors the world has ever seen. In today's video, we will talk about 5 rules Warren Buffett gave for investing during market crashes. So, let's get started with it. The 10-year bull run is coming to an end. Since Buffett took over Berkshire Hathaway in 1965, the S&P 500 has seen 12 negative years, and in 10 of those 12 years, Berkshire was still able to beat the S&P. And now in 2022, which so far has produced a total return of over 3.6 million% through their regime of acquisitions and stock investments. Buffett's exceptional ability to invest during market crashes is a big part of that success. S&P 500 lost 22%, and in Q1 alone, Buffett sunk $40 billion into the market. Let's find out 5 Warren Buffett rules you can implement to help you invest well during this market downturn. Number 1. Never panic sell. The very first thing you need to remember is to resist the urge to panic sell a successful company.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
According to Buffett, selling your stock when it declines in value is the stupidest move. Some people, according to him, are not emotionally or psychologically prepared to own stocks. But I believe that more of them would be if they learned that what they were purchasing when they bought stocks was a piece of a business. He also claims that the longer you hold stocks, the less risky they become, as opposed to the longer the maturity of a bond, the riskier it becomes. All of this comes back to Ben Graham's concept of Mr. Market, which Buffett alludes to in that video and states that you should never sell your stocks.
If you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15.
Regardless of how much someone else is willing to pay for them. Similarly, if you own a portion of a successful company, you wouldn't want to sell it just because your neighbors are prepared to pay you less for it. This just doesn't make sense. Warren Buffett makes the grossly erroneous claim that the stock market is the only area where investors leave a store during a sale. Sell a stock if the fundamentals have changed, without a doubt. If the price decline is the result of a factor that will permanently impede the company's ability to generate cash flow going forward, and it is no longer rational to hold the stock, then by all means, simply sell it. However, if you've done the research and are certain it is, Buffett's first lesson is that selling a great company that is being sold off along with the rest of the market is foolish because the price may drop. The second lesson is somewhat on the opposite end of the spectrum and is to understand that market crashes are enormous, yet infrequent opportunities, so make sure you take full advantage of them. Number 2, take the opportunities.
The biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. But I did know enough to understand Fannie Mae, and I blew it. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. Big opportunities in life have to be seized.
That is a noteworthy statement from Warren Buffett because it is rare for the market to plunge and lose more than 30% of its value. Market declines of 10% occasionally are expected, but significant market declines of 30%, 40%, and 50% are more common. Those occasions don't occur very frequently. You are aware that 2008 was the year of our most significant event. You could argue that 2020 was a big opportunity, but in reality that only made corporations properly valued rather than making the vast majority of them cheap, as happened in 2001 and 2002. As a result, there have only been 2 significant opportunities since 2000, which isn't very often. In light of the current situation, predicting the high and low points can be challenging, But if you notice a shockingly low stock market, you should probably seize the moment. However, what should you buy in such a situation? Buffett further says that too. Number 3. Understand what you're buying. Well, Warren Buffett suggests, I have an old-fashioned belief that I can only or should expect to make money in things that I understand. And when I say that, I mean I don't understand the product, but I understand the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what economics will say. Evaluating a company is within what I call my circle of competence. I understand the economics and the competitive aspects of the business. Therefore, if you don't understand a company, you shouldn't invest in it, no matter how cheap it gets. For instance, you may have purchased shares in Lehman Brothers in 2008 because they appeared to be extremely inexpensive, but it wouldn't have been in your favor. Because they are inexpensive after the market breakdowns, avoid purchasing from individual companies. You must first make sure you comprehend them. Number 4. Buy good companies. Your buying list should be sorted by the least expensive. Always arrange your watch list according to the company's quality. I have been taught by Ben Graham to buy things on a quantitative basis. Going for the things that are cheap made a big impression on me. Time is the enemy of lousy businesses. I could have sold Berkshire and made a lot of profit, but staying with those kinds of businesses is a big mistake. So I kept buying better businesses. Warren Buffett's major contribution to the value investigation strategies framework has been this point. Buffett changed everything when he said, "To hell with rubbish companies. I just want to invest in things I can hold for decades that are high quality and will compound internally." Ben Graham was the first to write extensively about the value investing approach, but his idea was to buy a diversified group of pretty bad companies. They were extremely cheap, so the stockholder got one last chance, and then you had to sell and move on. But Buffett decided he would stop listing the businesses by how cheap they were, and instead he would list them by their quality. He would never overpay for these businesses, but would settle if they were reasonably priced. That is a very important lesson to observe during a market crash, because during a market crash, you get thrown a lot of cheap businesses, and they are cheaper for a reason. So don't get lured by that, but focus on whether they have ample cash, low debt, a strong competitive advantage, great return on investor capital, and great growth, and wait for those countries to be fairly priced. Number 5. Focuses on the long term. Lastly, maintaining long-term focus is the most important lesson from a market slump. If you take the 20th century, it was unbelievable for the United States. If you take the whole 100 years, it went up to 180 for every $1,000, became 180,000. But 43 3/4 were those 3 big bull markets, and 56 1/4 years were periods of stagnation. All in economies were doing fine. How can a country be doing better and better? Every generation was living better than the one that preceded it, but had these huge changes. Big gains and long periods of stagnation. The answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and say, I am making more money than previously, so I will borrow. They keep pushing and pushing, and when they look in the rearview mirror, they find it to be the lousy business to be at. Stay objective throughout that if you can detach yourself temperamentally from the crowd, you get very rich. You don't have to be very bright. It doesn't take brains. It takes temperament. He is correct when he says that investing in the market requires temperament. You are aware that when the stock market crashes, reason and logic are often forgotten. Everyone becomes frantic, and a small debt spiral is set in motion. You have to be someone who isn't concerned about the next week or month, but knows that the money they put into the markets will be there for the next 10 years. This is because the market declines faster when more individuals want to get out. It becomes simpler to invest amid market crashes if you can commit to that. So, do let us know which topic we should cover next. If you enjoyed the content, give us a like, and thank you for subscribing to our channel. See you at the next one. Bye.